Hey there, Terry here. Just wanted to jump in with a quick midsummer's update for you. Or is it end of summer? Maybe closer to the end for the kids going back to school. And I hope you're staying cool out there. It's always a pleasure to check in and share a progress update, not just about your investments, but about how we're navigating what's been a wild year. The first half was a roller coaster. Yeah, remember that? Plenty of headline drama, lots of market noise, and a few heart-pounding twists and turns along the way. But through it all, we made it, and I just want to remind you of some of the timeless investing principles and wisdom that guides us through such times. So let's bring it back to the basics that shape our journey. Number one, we're long-term plan-driven investors, not market timers or speculators. That's for the other guys. What that means is every piece of your portfolio is built around your biggest financial goals. We don't chase fads or try to call the next market move. Instead, we stick with what works, a well-crafted plan with your future in mind. Nobody has a crystal ball, but you knew that. And we don't believe anyone can consistently predict what the economy or the stock market will do next. So we don't even try. And we especially don't believe in hopping in and out of the market every time the headlines get spooky. So what is the secret sauce then? Staying invested. Yes, history teaches us that the real magic of compounding happens when we let our investments and our patience do the hard work. Of course, markets rise and fall, sometimes bigly, dramatically. But every so-called temporary decline has been just that. It wasn't different that time nor this time. They've been temporary. Dividends keep rolling in, reinvested into more shares at lower prices, quietly building wealth in the background. Now, about these past 6 or 7 months, well, if you peeked at your statement or the stock market back on January 2nd, then looked again at the end of June, you might think, not much really happening here. But between those points, we saw a dramatic dip. The Standard & Poor's 500 hit a record high back in February, then quickly dropped nearly 20% by early April on the news of surprise tariffs. Yeah, remember those tariffs? Panic was everywhere, at least for that moment. But soon after, with a change in policy and improving economic news, the market snapped back, wiping away much of the drama. All along, the best course, really the only smart course for us long-term investors, was to stick to the plan and keep calm. That's what I encouraged then, what I encouraged before that, and it is still my message. I'll keep repeating it. Ignore the noise. Trust your plan. Turn off the TV. Don't listen to the headlines or read the headlines. Does anybody even read USA Today anymore? Just to be clear, I don't have a forecast for the markets in the next 6 months. Truthfully, no one really does either. My only prediction is that the strong, innovative companies you own will keep doing what they do best, growing, earning, and supporting your long-term dreams. This spring's market drama could serve as a teaching moment. There were some investors who bailed out, really, probably a lot of them, and they bailed out at the bottom, locking in their losses unnecessarily. While those like you who maintained course stayed on track for the goals. The bottom line is, it's always a choice between long-term discipline and short-term emotion. My mission, which I truly treasure, is to help you keep choosing wisely. I always welcome your questions and thoughts anytime. Shoot them my way. And thank you, as always, for your trust. It truly is an honor to be your advisor.